Welcome everyone to Klaas Financial's quarterly webinar, where we talk to you about trends we're seeing in the marketplace and answer your questions. We're going to be taking about 30 minutes on this webinar to go through some slides with you. And so we certainly appreciate you chiming in on this balmy Thursday. To my right here is Todd Eklund. He's our Director of Portfolio Management. My name is CJ Klaas. I'm the president here at Klaas Financial. I'm also an investment advisor, or a financial planner, as some people might call it. We represent cross disciplines of the organization. Todd works on what we would consider the money management side of our firm, and I work directly with clients. It's intentional that we have this cross discipline on these webinars each quarter. As I mentioned, we expect it to run about 30 minutes. We do record these webinars, so if you have to log off or you want to share any of the content with a friend, we will be posting it to our website and then send out a link to all of you within the next couple of weeks. I also want to remind you, at the bottom of your screens, you should have a little Q&A button, is what it is. And we do want you to actually, all throughout this webinar, if there's a slide or a topic that we discuss, and it's something that you have a question about, go ahead and click on that Q&A, submit the question now. I will warn you ahead of time, we are planning on answering all those questions at the end of our webinar. So just kind of hold tight as we fill up the Q&A roster, and then we'll answer them at the end. Now, moving into some of the content of our discussion today, let's begin with looking at just a reminder of who Klaas Financial is. So we've been in business for about 46 years. We have just over 1,000 clients that we work with, 20 employees, 670 million of assets, 675 million of assets under management, and then we operate in 29 different states. It's actually kind of interesting for us to see a map of the United States, because we continue to cover more of the states over time.
Expand our reach.
Expand our reach. Now, I will say we've been doing these webinars for about 1.5 years. So I did go back and look 1.5 years ago. And about 1.5 years ago, we had 3 less employees and about 100 million less in assets under management. So obviously the markets have been good to us. Our company has continued to grow, and we certainly feel honored to be working with all of you.
Good times ahead.
Good times ahead. As we move into our next slide, we're going to be starting with a hard-hitting topic that I'm sure all of you are thinking about today, which is inflation, as looked at here by CPI. Now, often people will kind of argue about CPI because it actually is less food and energy. And of course, food and energy are quite volatile. But the reality is, when you add in food and energy, it just basically adds to the volatility, but it doesn't change the core numbers that much over long periods of time. So don't argue with us too much about the CPI number here.
Boy, that looks high, regardless of what goes into it.
It does. So here's the point. Down at the bottom axis there, you can see that on the far left, it begins in February of 2000. And it basically is coming to present day here in, through September of 2021. And the point we're trying to make is look at that spike. That is a significant spike. And that is something that we believe all of you listening here should be aware of. If you have money sitting in cash or in a bank account, you will be feeling the impact of inflation eroding the purchasing power of those dollars. Truth be told, it doesn't matter where you have money. Even if it's in the stock market, the net result of that stock market performance over the last 12 months has still been muted by the impact of inflation. Now, I do want to mention to you all, financial planning, we believe, helps immensely as it relates to managing inflation. Not that we can predict it. We don't know when inflation or control it. But one thing that financial planning will do is it'll make sure that you're not living at the maximum level of your means. You'll be living somewhat below those means. So when inflation spikes, you have room to grow that budget. It'll also make sure that you have an emergency reserve. If anybody has worked with us for any period of time, you know we harp in our meetings on having a solid emergency reserve. And while you don't want to have too much money in cash at the bank, you want to have some, because if suddenly you lose your job in the middle of an inflation spike, you don't have to panic because you have the reserve, you have your investments, you have diversification. So while this scares us and we can't predict it when it's going to happen, we also know that financial planning should be helping all of you get through challenging times. Moving on to our next slide. We're digging a little bit deeper now into
not looking at the long term, but right now.
Exactly.
Yeah.
So this is looking at things that are impacting you day to day. Now, I'm sure some of you have incremental impacts in other factors besides what we see on the screen here, but we want to just point out three categories. At the store, so this is meats, poultry, fish, and eggs. They're up 12.5% in the last 12 months. At home, as defined by piped gas services, up 24.1%. And finally, at the pump, up almost 50% in the last 12 months. I'm willing to bet every single person on our webinar here today is being impacted by all three of those. And if not all three, certainly at least a couple.
Now, in the past, we've kind of joked that certain elements with inflation, like, flat screen TVs have gone down.
Right.
But today, I mean, it's pretty clear things that we all spend money on have really precipitously gone up over the past year.
Big time. And we would argue that this is really just a convergence of factors. Really, this would be supply chain disruptions met with a COVID crisis. Now, there are many different factors, as Todd will say. We're not going to dig into all the factors, but it's a convergence of all of these factors, largely driven by the supply chain and COVID, that has caused certain areas like this to go up. And certainly you could argue, as it relates to gas at the pump, that could also be policy driven.
Can it get worse is the question.
Right. Do you have an answer to that?
No, I think I maybe transition, but
yeah. So let's actually consider that.
Yeah.
Let's look at the next slide, which is going to talk about that a little bit. So
it can.
It can. So what we are looking at here, let me define what you're seeing on your screens, is that we are looking at inflation. On the far left is January of 1961. All the way through, you see the 1970s and 1980s there. Most of you who are on here should have been alive then and well aware of what was happening during the Reagan administration, as we had stagflation, which Todd will talk about here in a second. And then you notice it came back down after the 80s, and now we're back out to the far right. We're back to September of 2021, and we see that spike again.
It's quite a breakout.
Yes. But the point we're trying to make on kind of spreading out and showing you more data as it relates to inflation would be, it can get worse. It could get higher like it did in the 1970s and 1980s, although Todd will talk about that here in a second. However, I also want you all to see from 1992, you see we have that trend line, sure, the average at 3.7%. From 1992 all the way out to 2021, we have been well below the average. And if anybody here deals with statistics, as we do, we know that things will tend to bounce around the average over time. And if they're well below the average for a long period of time, we just know that there is going to be pent up demand, so to speak, for higher than average inflation at some point. So we would actually argue this doesn't surprise us that much to see it finally, after almost 30 years of below average, to see it finally pop back.
Let's talk about the 70s and early 80s for a moment. Different time. Many of you on this call may have experienced it, and just remember how bad that was, not only for going to the pump, gasoline, but also more importantly, investment returns. There's a stagflation scenario. What we're looking at here is a scenario where you have a low growth in the economy and extremely high inflation. And that's a combination that neither stocks or bonds do very well. And it can go for a long time. You look at it, you could call it the lost decade of the 70s and 80s. So the point I think we want to make today is that it is different factors, and we don't want to scare anyone that this is a breakout to the 1970s that we're right on the precipice of it. We try not to make too bold of predictions, but we also want to illustrate that there are differences in what are driving these things. If you think back to the 70s, it was an oil shock coming out of the Middle East. There was a lot of policy issues around that. The conditions are a bit different today. We're less reliant on oil than we used to be, not completely. And you can make the case that a lot of these elements that we're dealing with the pandemic, with shipping, supply chains, are things that could fairly soon ease.
Yep.
So too soon to tell, but also too soon to panic, right?
Yes. Yeah. So I think to Todd's point, that period of kind of yellow you see on your graphs there of stagflation in the 70s and 80s, we don't see that currently. We don't envision that happening, although we're also not making a prediction about the future. Time will tell as we move forward. But again, in all of this, rarely does panic help. And so our encouragement would be and we're going to talk about this as we go throughout the webinar, but there are some things you can do to help kind of control. There's some things we can do to help, but financial planning should help across the board to manage these types of environments. We also want to empathize. That is a noticeable breakout in the last 12 months that should be making all of us raise our eyebrows.
No doubt.
Because high persistent inflation, again, for anybody who lived through the 70s and 80s, can be a killer. And so we are very aware of it, and we're mindful of it as we move forward.
And so we'll move along to a different topic, something a bit less scary, I suppose, for most of us. One of the things that's been in the headlines recently, you've probably been reading about it, is the so-called Great Resignation. And it's been interesting to read about, observe the trend. What we're looking at here on the screen is the quit rate for jobs in the economy. Now, that is a noisy chart, but I thought it illustrated it well. This shows it for each year on a rolling monthly basis. And you can see the orange line in 2021. It's clear why they're writing articles about this right now, why it's being talked about. This is a distinct break from the norm that we've been observing in the quit rate of jobs. And what that comes from, by the way, is there's a survey through the Bureau of Labor Statistics that goes out to all employers in the economy, and they collect data on job openings, why people left. So they do this every single month, and it's not perfect how they collect it, right? But it can give you a broad pulse on what's happening in the economy. So this has been interesting to observe. There's no doubt that more people are leaving their jobs. I think one of the things that we'd like to dig into on today is what it means for different people and what's underneath that. Certainly, should you quit your job, right? I think it's easy to look at what's in the headlines and think that maybe I should go that route. But if we move ahead to the next slide, when you look below the surface of this quit rate and the Great Resignation, I would actually contend that it's a lot less interesting or relevant. I'm surprised that it's getting this much talked about when you truly dig in and look, what's under the hood of those numbers. And so if we look at what the quit rate was in 2019, that's that light gray line, we can see that it's up now in 2021, but not to a tremendous degree. I wouldn't characterize that as a giant break from the norm by any means. This is on a percentage basis, right? Now, what we do observe is that in certain sectors of work, what we have on the screen here is leisure and hospitality, so hotel employees. I was just in Chicago at a conference. It was dead downtown. It took 30 minutes to get the car. So clearly, in certain sectors, there's things going on, and you can see that in leisure, for instance, is triple from where it was before, almost, right? So, anyways, we would encourage people to take that with a grain of salt. I think if you're 42 years old, you have a great job, and you're thinking, well, should I just quit to, work from home? Maybe, right? We would say that's probably something that we can help you evaluate. And certainly, remember, we do talk with clients, CJ, about, can they leave their job? What sort of window would they have to maybe try something on their own, do consulting work? But we would caution you from jumping into the shallow end of the pool before you know sort of exactly what that's been like.
Well, so let me mention, for anybody who's traveled like Todd has, or is dealing with a hotel, or dealing with maybe airline support in trying to get through to find out where your bag was lost. That's me. There are certain sectors where we are really feeling the impact of either quit rates or the COVID crisis as it relates to people having to stay home when they're exposed, or their kids are home from school due to COVID. And so within these narrow sectors, we are seeing some major spikes in volatility. But I think the point that Todd is making is when you look at the gray bars of 2019, 2020, and 2021, the light gray bars, you notice that the overall quit rate hasn't actually dramatically jumped. It's just in certain sectors.
It's no exogenous migration, right? So if we move to the next slide, we want to talk a little bit more about some of the factors that are driving that. Again, what's underneath the hood. So what we're looking at now is wages and salaries. So this is what are workers being offered, right, at their jobs. What's interesting about the people with the quit rate at hotel and leisure is that you can see that the compensation and wages and salaries offered to those same people who are quitting those jobs has risen significantly from where it was before, almost 2.5 times higher. Now that I shouldn't say in a percentage rate higher, right? So let's keep this all in context. But so that's, you can quit your job as a hotel worker. They're offering you more than they were than before to come back, but clearly not enough more because there's still a shortage. So that's interesting. I don't know what that will mean longer term. Is that just seasonal, CJ?
We'll find out. Again, I think a lot of this gets driven by the demand for lower waged employees in certain sectors. So if you're running a Starbucks, a franchise business where you're paying somebody $15 an hour, keeping those people has become more challenging. Partly because there's a large demand for a lot of them, but partly due to the fact that COVID has a lot of these people not able to work the same hours they were able to before, meaning they actually need a larger workforce to cover the same number of hours that they had before. So when that's a function of demand, a supply and demand. And therefore, when you find out that Starbucks is going to pay more than Seattle's Best, these are terrible examples, by the way, but you jump, right? Because you can move easily to another job at those lower wages. Now, here's what's interesting. I don't know if you all have done any reading on this, but if you've been watching the news, if you've been watching presidential candidates for the last 8 years, I would say there's been a huge focus on minimum wage, right? About kind of a federally forced increased minimum wage. Well, here's what's fascinating. In the last 12 months, we have had the largest countrywide minimum wage increase that was not policy driven. It was actually supply and demand driven. So we should all remember that. There's 2 ways to raise minimum wage. One is through policy, right? Which I'm not saying that's right or wrong. But the other is actually through the supply and demand curve of the industry that you are in. And it's kind of proven by this. You can see in the leisure and hospitality where they're struggling to maintain people, they've had to jack up the amount that they pay them dramatically to keep them there.
Now, my fiance, Blair, she doesn't like her job in finance and accounting, but I'll make sure to tell her she's not ready to become an Instagram influencer quite yet. So
there you go.
We'll move along.
Yeah, so looking at home prices in tandem with the stock market. So this is kind of interesting. This is a Case-Shiller report on US home prices. Again, on the far left there is 1987. Moving out to the right is March of 2021.
It's quite a breakout too.
It is. And you can see in the middle there where the home prices declined was actually right after 2007 as we went into 2008, the Great Recession as they call it. And we all know homes, subprime lending basically led to the 2008 debacle, and therefore home prices took it on the chin. But if you can see on the far right side there, in the last year or so, it had been going up pretty steadily, almost like an escalator. And then in the last year, you've seen a huge spike here in your home price. So back to financial planning. What we would argue is that there are always going to be things during certain times of the year, certain cycles in the economy that are doing better and things that are doing worse. Most of you should know that cash is not doing very well right now. If you have inflation spiking at 6 or 7%, it just means you are losing purchasing power. But as you know, you need an emergency reserve for emergencies. But your home, if you own a home, you have seen an immense increase in your overall wealth just due to your home. If you own stocks in the last 12 to 24 months, as we will see on our next slide here, have done quite well and have been a nice kind of offset to this inflation. So it really depends kind of what you're exposed to in the economy as to whether or not the inflation is impacting you severely.
Look at those numbers.
So this is staggering. I want to describe what we see on the screen here. 2019 on the left, 2020 in the middle, 2021. This is a balanced portfolio of about 60% stock, 40% bonds. We use this as an example because it's actually the largest allocation of where our retirees sit. Some are more aggressive, some are less, but this is about the average.
It kind of defines the average investor out there.
Defines the average investor. We would say that the average rate of return of a 60/40 portfolio over long stretches of time should average somewhere around the 6% nominal number.
5.5, 6, whatever.
In that, and it depends on the 10-year cycle, but around 6%. In the last 3 years, you have seen 19, 12, and 10. The average of that is about 14%. We are talking more than double the average return of a 60/40 balanced portfolio over the last 3 years. Therefore, we would say, hey, if we run into a year where there's some loss or a bit of a decline, and again, we're not predicting that, we don't know when it will come, but if we run into that, it actually wouldn't surprise us at some point, given that we have seen, again, above our expectations over the last
Things
3
have been good. Don't think because things have been good that it's right about to get bad and fall off. The usual likely scenario, right, is that it'll just be lower than you've come to expect more recently, right?
That's right. So I appreciate Todd mentioning that. We are not saying that due to these 3 higher than expected years, you should expect suddenly a market correction. That is certainly not what we're saying. But it would not surprise us if over longer stretches of time, we end up hitting our 6% averages on a 60/40, which will mean there will be good and bad years ahead of us.
And those are the same numbers that go into our plans.
That's right.
So
that's right. So moving on to our next slide. We don't want you to hear this presentation and feel powerless, as though we are saying, don't panic, everything's fine, because I'm sure many of you are feeling a bit of anxiety as it relates.
If you're on a fixed, income in retirement, how could you not? Right?
Absolutely. If your income streams are coming in and they're no longer meeting the expenses like they were before, there is reason to feel some angst about that. So we wanted to end this part of the presentation talking about levers that you could pull on that are reasonable. Because what we want you to remember is that financial planning isn't about removing your decisions. It's about giving you the right decisions to make. So think of it as pulling on the right levers and not the wrong levers. So let's talk about some of the levers that you control that you might want to be thinking about right now. Lever number 1 is spending. Remember, if you're listening to your financial advisor, they should be working with you on making sure that you are not spending up to the max of what you can possibly afford. And therefore, you have some control over your income in the midst of inflation. If you come to me with your advisor and you say, my goodness, we need a little bit more income to sustain our lifestyle due to inflation, your plan should allow for a little bit of movement there. Additionally, if you're concerned about the impact of inflation on your portfolio, you can always cut out some expenses if you want to, or if you're able to. The next category would be savings. So if you're not yet retired, you can consider how much it is that you are saving into your retirement account to take advantage of lower market declines or to try to save more for the future. Timing. So we would reference not timing of getting in or out of the stock market, but when you want to retire. So these are elements that you control. You may say, I'm going to wait a little bit, allow things to settle down in the economy before I finally choose to retire.
Maybe you work part-time and go back and be a hotel concierge.
That's exactly right.
The demand is up, right?
So actually, to Todd's point, not so much about the hotel concierge, but the point being that, hey, you may say, I need to be done now. I don't care if inflation is spiking. I don't care what's going on. But we would say just be flexible. So maybe what you do is you say, I'm going to retire now, but you know what? I want a little structure in my days anyways. When I'm retired, I'm going to work 10 hours a week, get paid a good amount of money for a minimum wage job, and actually just allow that to supplement my income in retirement while inflation is high. Next couple of categories would be risk, the level of volatility in your investment portfolio. Now, often people misunderstand this and they say, oh, you're saying that if volatility spikes or if I see something happening, I should come into you and make major changes. No, but we are saying that you do control the investment allocation. And maybe as time marches forward, as you're maybe getting older, you're becoming less tolerant of volatility, you could back down your risk. Or conversely, you could say, I don't need this money. It's mostly for my kids. I don't want to be impacted by inflation, and you can take on more risk. The point is that that is an element of control that you have over the present day events.
And what it'll do for you over the long term.
That's right. And the final lever that you have to control is your legacy, how you want to transfer money to your heirs. For those of you who meet with us, we spend a lot of time talking about where you are now, where we project you to be in the future, and therefore what we should do now to address kind of legacy planning for your children or grandchildren. So that's another thing. In the midst of the instability or uncertainty of what's happening today, one of the levers you can control is trying to maximize your present day tax environment to benefit the way in which you pass on assets in the future. One of these strategies, as many of you know, some people have heard us talk about donor advised funds. Others have heard us talk about Roth conversions. There's many strategies to consider.
I would just say, depending on your circumstances, there always could be a lever to pull. It might not be fun to say, I'm going to sell this other property or something to that effect, right? But, if we think inflation is going to be high and it affects you, there's ways you can adjust.
Yes. I do want to mention, there are levers not to pull. So let's end with that before we go to your questions. A lever not to pull would be to call us in the midst of volatility in the market and to sell everything to cash.
Which does happen.
It happens. I understand where it comes from. Listen, I'm a human being. I understand the emotional toll on the money that you've spent a lifetime building up to see it be volatile, to see inflation. But a lever we would highly suggest you do not pull is what we call the light switch on or the light switch off. It's human nature that when we see fear, we want to switch off the light or we want to go to cash. In our experience with this, and by the way, this has been empirically studied as well, it is one of the worst decisions that you can make in the midst of volatility in the market. Second lever to not pull, we would humbly suggest, would be to call and say, I want to buy all gold or all Bitcoin, because I believe those will be the hedges against the future. Now, please don't misunderstand me. We are not saying that gold is bad. We are not saying that cryptocurrencies are bad. What we're saying is that these are speculative, fear-driven purchases that we would suggest you do not.
It's not going to be your silver bullet against this.
No.
We don't want to make an opinion about whether they're good or bad, but to think that is your solution because inflation is happening is probably poor thinking.
Yes. And the final lever we would suggest you don't pull, which goes back to the whole quit rates and what we've seen happening in the economy. We do not suggest that you suddenly quit your job out of nowhere and come into our office and say, I quit and I'm going to find a higher paying job. It's not that you can't do that. It's not that we don't want to help you stop working at a place you don't enjoy. It's not that we don't want to help you plan for a better job or even plan for retirement. It's rather that just because there's all this activity in the markets around people shifting jobs that are higher paying, you really need to slow down and plan for something like that and not just react out of fear or react out of what you're hearing.
And we're here to help people with that. As we said earlier, that it's something that we do help evaluate.
Yeah. So on the screen are the levers that you could pull. Those three that we just went over would be levers we would suggest that you don't pull. And let me just end with this before we go to your questions. If there's one thing I've learned in the last 15 years of doing retirement planning, and that I've seen play out over the last 46 years of Klaas Financial's history, it would be this following phrase: when you enter retirement, be flexible. Let me repeat that. When you enter retirement, be flexible. Often we get our minds, as we get older, as we get into retirement, we lock our minds on, I need this much income or I'm not going to be happy.
It's good advice for all ages.
Well, that's a good point. We all need to hear that. But especially in retirement, because we think to ourselves, I've been flexible all throughout my life. Now I'm not going to be. But the reality is the world changes. Things change. And therefore, just be flexible with your income, with your investment allocation, where you're going to be, what you're going to do, because things will change, as we've seen here in the last 12 months. Well, enough rambling on our part. Let's go to the Q&A.
And we got some good ones as usual, so we appreciate them. So CJ, we'll start with you on this one. If I didn't get a big raise this year, am I not keeping up with inflation, or should I worry?
Oh, good question. So I actually had a client reach out to me on a question very much like this. He was asking about percentage raises and what should be expected. And so here's what I would say to you is, if you didn't get a raise to match what you believe inflation is, don't worry, you're not alone. A lot of people have been impacted by this, because here's the what happens for businesses is they have to be making strategic decisions all throughout the year about mergers and acquisitions, about strategic investments, about hiring new people, all of those things. And then suddenly overnight, and I mean overnight, in the last 6 months, inflation spikes. Your employer may or may not have the excess cash to give you the full raise that you want. Now, some employers are doing this, but they're doing this in a backdoor way by actually laying off people, putting more on the plates of the existing people, and then giving them a larger inflationary raise. So just recognize there is no silver bullet, even as it relates to these inflationary wage increases from employers.
I suppose we were talking about this in this. It's sort of how close were you to the line, right?
Right.
We want to be, if you're someone, and I guess that affects you at different phases of your life. I can tell you that if I was 24 years old, correct, sharing an apartment somewhere, yeah, I would probably be really, really worried about, inflation going up by 15%, 10%. I know we haven't seen that, every dollar counts for me at that age, right? So, how would you answer that at a midlife person and then also a retiree?
Yeah. So to Todd's point, financial planning helps in all of this. I hate to go back to this over and over again, but if you're living below your means, even if you're at a lower wage job, if you're living below your means, then this 1 year of your employer not matching inflation, you should be able to get through it. Now, if your employer has multiple years of not keeping up with inflation, you're going to eventually have to address that with them. But I would say 1 year of not matching it, be patient with your employers. These things take time to actually watch them flush out.
And sorry, for the retiree, you got an adjustment, right?
So, right, exactly. With the retirees,
with, Social Security.
That's right. Yeah. So as retirees, we got a 5.9% increase year over year on Social Security and other factors. So it depends on where you are in the phase of your life, but be patient with your employers.
So should I have more stock exposure to beat inflation?
I'll let you answer that one first.
Maybe. I say maybe. Will I teach her? Probably. It depends on who you are, but I would generally suggest that if you think you can take no risk and beat inflation, it's probably a myth, right? So, as an example, the person that calls in the market drop and says, "I want to go as conservative as possible," and we might convince you, well, keep a little bit in, go 20-80, just put, it's that whole mentality, put something in the market, get in the market a little bit. That's why we don't advise the light switch, right? It's about staying the course. And so, I think it's one of those things that if you're a long ways out though, from when you need to retire or you've got a long horizon, maybe going upward a bit is a good thing at this point, that if you can really keep your eyes on the long-term prize, stay the course, realize the span that you have in front of you, there's no reason why you couldn't go a tad bit higher on your risk, than probably the average person usually does.
It's a great question. It's something we're addressing with all of you as you come in for your reviews to talk about the risk versus reward trade-off. I will say, again, our behaviors as human beings tends to be extreme. I'm in this with all of you, in that when we see inflation, we say, I would need to own more stocks to keep up with it. And then now we're seeing what? Oh, now we're seeing the market tail off a little bit. And it's, I need to own more bonds and cash. And the reality is you need both.
All the time.
Now, if you're my age, my portfolio, at least, I have an emergency reserve, a savings, I have money set aside for different things I want to do. But if I'm younger, maybe my portfolio doesn't have much in bonds because I'm not worried about the insurance when the market goes down, right? At least right now. But for the vast majority of all of you listening here, the reality is you need both at all times. But the question is, what is the right mix? And I think to Todd's point, it's something you should be evaluating with your advisor.
So we've got some really great questions here, filtering. I'm trying to think of the best segue for this one. I like this one next. I'm about to come into an unexpected $50,000, say through an inheritance. What are good choices in this current market for where to put that new money to work? That's interesting.
Goodness, that's a financial, well, everything's financial planning in my brain.
Not Bitcoin, but
yeah. If you come into a $50,000, we would be asking you questions. If your balance sheet is not clean, meaning if you have debt, one of the areas we would look at is there a way for you to take some of that money and clean up debt? The beauty of doing that is you get a guaranteed rate of return by doing so. Whatever the rate of return is, or whatever the interest rate is on your debt, you immediately save that. And secondarily, you often will free up cash flow by doing so. So one of the big areas we would look at kind of first glance when somebody gets an inheritance is, can we clean up the balance sheet? But assuming that's not the case for this individual.
That's not where mine would go originally, right?
Right. Well, and we have to be careful.
Yeah.
We as financial planners can be so number centric that we forget kind of the joy piece. So we would say as well, figure out what little portion of that you can utilize to find joy, right? To say maybe it's an extra vacation, maybe it's the car has been on its last leg and you need to swap it.
I would need you to remind me of that. Oh yeah, boy, you maybe should pay down some of that.
Right. So it's a matter of finding a little bit of kind of the dopamine hit of rewarding yourself, or we got an inheritance. It's a little bit of the cleaning up the balance sheet, and then maybe a little bit of saving for the future in your.
But if I'm hearing you right, it's not only a question of should I put this into the stock market. It's what other pictures in your financial life could that
absolutely
fulfill?
Absolutely. Great question. Thank you for asking it.
Let's see here. Here's a good one. You know, we had hoped to maybe avoid this, right? I think as we talked for the preparation, because this is also a hard one to predict long term, but certainly in some people's minds. Does government overspending and accumulating large debt also cause inflation? We might disagree. Bill, start with you.
So the answer would be it certainly can.
Yeah.
Right. So from a pure economic policy standpoint, you look at supply demand, you look at money supply, and if you have more dollars chasing the same number of goods and services, we all know that can cause inflation.
It's a good way of putting it. Yeah.
So at a very base level of economics, the answer would be absolutely. However, what I would say to you is we have been, I'm going to show. We have been heading in a direction, not just under one president or two presidents. We're now under 3 to 4 different presidents.
And for a long time.
Right. In an increasing of our debt. So what I would say to you is, this to me is not a Republican or Democrat issue. This is a US issue right now that we have to figure out who's going to eventually kind of call everybody to the table and say, we're not going to continue spending and expanding our economy the same way we have been, and we're going to be responsible and not grow government debt.
I would just say, you know, we've been spending like this for a long time, and to your point, it hasn't mattered to the political party. It happened.
Right.
We saw definitely an increase during COVID with what the government spent to sort of stave that off. But honestly, it wasn't all that. It's a move upward, but it's not all that different from what the trend has been. So I think. Right. Assuming that is the root cause right now of why we're hitting 6-7% inflation, and that we're that's the only lever to pull to stop and pull this back, I think it'd be perhaps too soon to reach that conclusion.
But I think it's a great question. Thank you for whoever asked that question. Wonderful question. It's a real world application of, hey, can our elected officials be doing things better to try to help us with this? We would say yes, but it's not just elected officials. It's also the fact that COVID, an unknown, COVID pandemic hit the world and really seized up supply. It's not only impacted the United States, it's impacted everything globally. So no matter who was in office, I think we would have had some level of inflation.
I don't see it ever going down under any party currently. Like the
debt level.
There's just too much. There's too much that each side would have to go, and it are sacred to each to really move it. And so I think the long-term things just keeps going up and up and up, and we continue to generally be okay, in my opinion.
Yeah, that's a big topic.
Yeah,
maybe something for your individual meeting with your advisor.
So let's see here. Supply. Well, I want to be cognizant of the time, by the way, and we can answer a few of these after.
Yeah.
As you see the final 2 questions, CJ, what do you think here?
Yeah, let's look at the last couple here. One at the top here is the supply chain being fixed at present? Why don't you start with that one?
Boy, I don't know. I don't think so. Did anybody else watch 60 Minutes the past few weeks ago and see the episode about the tanker ships in California outside of Long Beach? It's really interesting to see all the ways right now that things are still odd. I mean, I don't feel like my life has changed all that much with COVID dragon. I still see you coming to the office every day. I've flown on an airplane and gone places, but there are areas, right, where things have really are still come to a dead stop. And so I don't know that it's being fixed. Although some of the people on 60 Minutes think that there's foreign aspects to it with,
Right.
But do they want this to continue to drag out like this? No, I don't think so. And it's not a centrally planned decision to do this, in my view.
No, so remember, during the late 70s and early 80s, when we had super high inflation, we had stagflation. That is a poison pill for an economy. It's hard for any president to talk their way out of that. And therefore,
arguably it was the end of Jimmy Carter.
Right.
Right.
So my encouragement to you would be, no, the supply issue has not been fixed. As we speak, at last I heard, there was something like 120 large supply ships off the coast of California that are not able to dock, largely due to the fact that they don't have the personnel to get them in. And therefore, my comment would be, it is not fixed. It'll probably take a year, couple years, I don't know how long, for the supply glut to get flushed through to where actually we don't have this problem. COVID certainly contributes to all of this and the policies surrounding COVID, but these are big questions that unfortunately we can't predict.
These things work themselves out. You must recall that 12 months ago it was impossible to walk into a Staples and buy a webcam.
Right.
Right. And that self-corrected, right. Did you have to wait a while? But it is back to normal eventually.
Todd brings up a good point. I do think it will be corrected over time, but we don't know how long it will take.
Sure. All right. We're going to open up for the last one. We normally don't like to make predictions here, but someone felt it isn't. Packers 49ers. Who's going to take it on Sunday? Now you must know, I live in Wisconsin. I'm a big fisherman now, but I'm a 49ers diehard. I don't jump on the couch here when they beat the Packers in the last few years, but
well, I am wearing my green jacket in honor of the 49ers, or in honor of the Packers. So I believe it's going to be the Packers all the way. 49ers, no, not so much.
I may just hope the Packers, because it'll keep Aaron Rodgers happy and he'll stick around.
Yeah,
right?
That's true.
So
listen, everybody. Somebody just made a comment. Listen, everybody, we certainly appreciate you all participating in this webinar. We do recognize that often people think that we can make predictions about the future. And the reality is we cannot. We don't know what is coming, but what we know after 46 years of being in business, after working with thousands of people through thousands of retirements, is that financial planning and building margin in your budgets, having emergency reserves, being diversified, having equity exposure over long periods of time tends to breed long-term success. And therefore, we want you to know we appreciate the trust and confidence you've placed in us to help you work through these periods of uncertainty. We will plan to be back here in another quarter or so. Again, this is being recorded, so we will make sure we send out a copy of this recording to you via email in the next couple of weeks. But until then, Happy New Year, everybody.
Thanks for tuning in.
Yep. Bye-bye.